The 2008 financial crisis was one of the largest banking and macroeconomic downturns in the history of the 21st century. Over the course of 6 months and subsequent years, trillions of dollars of household wealth was lost in domestic and international markets. Several of the world's largest financial institutions, insurance firms, commercial, and investment banks collapsed in the wake of widespread financial miscalculation and subpar government regulation. More importantly, unemployment rates, foreclosures, and evictions peaked at extremely high levels. In many respects, the financial crisis of 2008 was the second worst economic failure, next to the Great Depression. The causes of the crisis were as numerous and complex as the collapse itself. However, many analysts indicate that there were a few primary factors responsible for the collapse. In the decade leading up to the crisis, inflation rates sustained between the target 2 and 4%, and growth remained stable. In many projections, the economic landscape seemed predictable and promising. In 2005, Congress altered the pre-existing Community Reinvestment Act, which intended to encourage depository institutions to help meet the credit needs of communities, including low and moderate income neighborhoods, consistent with safe operations. Despite strong economic forecasts, banking foul play began shortly thereafter. Changes to the Community Reinvestment Act incentivized banks to increase the amount of subprime mortgages, which are loans given to individuals with poor credit scores. Because of their target market, subprime mortgages have a higher default rate than the conventional loans. Commercial banks that targeted borrowers with poor credit scores who wanted new mortgages, refinancing options, and continuing lines of credit. Many of these subprime mortgage borrowers had not only one mortgage on one home, but also several mortgages spread across an array of properties, many of which were out of normal financial reach. As this process continued in the early 2000s, banks began accruing large amounts of subprime mortgages. Although the housing market trended consistently upward at the time, this was not the case. Unbeknown to banks, the U.S. was in the midst of a housing bubble, with prices peaking in mid-2006. In order to profit from the masses of subprime mortgages banks had collected before 2008, these financial institutions began utilizing a relatively new instrument, mortgage-backed securities. These mortgage-backed securities were large amounts of subprime mortgages, reorganized and bundled into a collection of mortgages. Commercial banks then sold these packaged securities to investment banks, and under the repeal of the Glass-Steagall Act, these transactions were now acceptable. In order to optimize trading of mortgage-backed securities, investment banks divided the mortgage-backed securities into tranches, or slices where purchasers could buy into a tranche instead of purchasing an entire mortgage-backed security. Like any other security, each tranche from an MBS was given a rating by a private bond rating corporation. Tranches with higher ratings had less risk as they were the most likely to be paid first. Taking it a step further, investment banks also eventually exhausted the repackaging of the lower rated tranches of mortgage-backed securities, referred to as collateral debt obligations. Although it now may seem logical to have given the CDOs a low rating, the contrary occurred in 2008. Because the collateralized debt obligations were marketed as diversified, bond rating agencies were quick to award these securities higher ratings than expected. Furthermore, with lack of government oversight, these rating companies often colluded with firms to rate CDOs as relatively low-risk securities, when in fact many of the instruments were simply bottom-tier, high-risk, reorganized bonds. But the rebundling did not stop there. After banks had created enough CDOs, other banks constructed new CDO2s or CDO cubes, which were forms of repacked, pre-existing CDOs. Once again, these securities were given relatively high ratings due to their diversity. This process continued until a large, unmanageable web was formed, essentially creating the framework for the following collapse. By mid to late 2007, housing prices began to slip and the housing bubble formed in years prior was on its way to bursting. By early 2008, aggregate housing prices fell by an outstanding 20%, an unprecedented amount in modern economic history. As housing prices declined, many borrowers began defaulting on their mortgages. The houses they now owned were worth significantly less than the value from which the mortgage was based on. Defaulting was a financially sensible option rather than paying one or more overvalued mortgage. As foreclosure rates rose, mortgage-backed securities lost value in an extremely short period. The collapse had begun. The collateralized debt obligations and the extensions of the mortgage-backed securities continued to lose value at exponential rates. The shadow banking, which a large sector of the stock market had been reliant on, was coming to a catastrophic halt. Declining market, the U.S. Federal Reserve injected $300 billion issued as bonds in an attempt to stimulate the troubled market. The institutions with the most MBS-related assets were the first to collapse. Organizations like IndyMac, and specifically the Blackstone Group, whose assets had lost 90% in value. In some cases, larger banks were able to purchase other organizations that had overinvested in real estate-based securities. Bear Stearns, for example, had been previously trading at $140 a share, but during the crash, Bear Stearns was bought out by JP Morgan Chase for a fractional $2 a share. Unfortunately, other banks became so submerged that they could not acquire a buyout. The Lehman Brothers, a finance giant who had billions in mortgage-backed securities-related assets, was not able to acquire a buyer nor a bailout, and consequently collapsed. The catastrophe was not limited to banks. Large insurance firms that were involved in credit default swaps also collapsed, as they could not insure an extreme loss of value in such a short period. But domestic failures were only a piece of the financial regression. Internationally, many developed markets saw a significant decline in value. Within the Eurozone, many German and Swiss banks, which had mortgage-backed securities, felt the shock of large-scale defaults. Consequently, East Asian manufacturing giants such as China and Japan were struggling to maintain growth under the sliding aggregate demand within the United States. China and Japan could not export as aggressively to the U.S., which was the world's largest market, because many U.S. consumers and firms had lost significant wealth in the collapse. During the fall, and well into the recession, the U.S. government was active in trying to stabilize the market. Amid bailouts and loans to various firms, the Bush administration signed the Emergency Economic Stabilization Act of 2008. This act established the Troubled Asset Relief Program, a multifaceted solution to the crisis. The TARP allowed the Treasury to purchase up to $430 billion worth of distressed assets, particularly mortgage-backed securities, in an effort to achieve financial stabilization. Another aim of TARP was to encourage commercial banks to lend to consumers and fuel economic activity. The financial crisis of 2008 was one of the most damaging and widespread collapses in financial history. Not only did consumers and markets lose trillions of dollars, but economic and financial theory were put to the test. Like the years immediately following the Great Depression, the battle between political parties raged on over the appropriate course of action. Many experts feel the U.S. has done too little, too late, and much of the collapse was dependent on lack of government regulation and bills like the Community Reinvestment Act that encourage consumers to purchase mortgages out of their normal financial reach. More importantly, the crisis tested the evolution of modern banking. From new models in financial instruments, firms created securities that to most were not fully understood. The crisis highlighted the need for better financial regulation at home and abroad. It is paramount that the United States government takes the appropriate regulatory measures to prevent such a collapse from ever occurring again. If our representatives are truly dedicated to revitalizing the economy and preventing such a disaster from taking place again, then 10 short years after the crisis is no time to abandon Dodd-Frank or any safeguard designed to keep the system from collapsing.